Good afternoon, everyone. This is Joe Bacella here at Chaikin Analytics, and I'd like to welcome you to our presentation of Part 1 of Supercharge Your Option Strategies. Presenting today is Marc Chaikin, founder and CEO of Chaikin Analytics, along with Tony Zhang, co-founder of Options Play. Throughout this webinar, please feel free to submit your questions using the Zoom Q&A window, which is available in the upper left-hand corner of your screen. As a reminder, this webinar is being recorded and a copy will be sent to everyone who is registered. Now, Marc Chaikin created Chaikin Analytics to put the power of proven stock research tools in the hands of professionals and individual investors. His latest contribution to Chaikin Power Gauge Rating is a 20-factor model that uniquely combines fundamentals and technicals. To show us how it can be used together with the Options Play program for option strategies, here's Marc Chaikin.
Thank you, Joe, and welcome everybody. A little bit of housekeeping. Neither Chaikin Analytics or Options Play is registered with any federal or state agency, so all the examples we're going to be used are not recommendations, but for educational purposes only. And an options risk disclosure, options trading carries a high degree of risk. Purchasers and sellers of options should become familiar with options trading theory and pricing. We're actually going to go into a little of that on today's webinar, but please get more information from the Options Clearing Corporation at the email on the screen and read up about characteristics and risks of options. So before I introduce my associate, Tony Zhang, a little bit about my background. 50 years on Wall Street. For 45 years, I've been using technical analysis along with fundamentals. That's going to be one of the themes of today's webinar, to find winning trades and investments. And for 5 years, I headed up the options department at a very good regional firm called Tucker Anthony and R.L. Day. Over 250 brokers, tens of thousands of options traders, and I can tell you that 95% of those options traders lost money. So one of the things we're going to share with you today is a way that you can be part of the 5% who does make money. We call it the directional edge, and I think it'll make a lot of sense to you. Along the way, I've been mentored by some very successful institutional investors. Some of them were colleagues and some of them were clients. The reason that's relevant to today's webinar is because in 2010, I created something that I consider to be the culmination of my life's work. It's called the Chaikin Power Gauge Rating. As you'll see, after we get into a bit of option strategy, it synthesizes 20 factors into a multi-factor model that, with a high degree of reliability, tells you which stocks are likely to outperform or underperform the market. So with that, I'd like to introduce my colleague, Tony Zhang. Tony's been a great partner with us since we integrated Options Play. And Tony, why don't you tell people a little bit about you?
Thanks, Mark. Thank everyone for being here this afternoon. My name is Tony Zhang. I run the product strategy team here at Options Play. I started my career actually on the FX side as a trader in sales, helping people better understand how to trade the currency markets. And that's actually how I got started with options, because I was building out a lot of the education and talking to clients about how to trade FX options. And I had the opportunity to start this company 5 years ago, Options Play, because I realized that, as an options trader, at the time myself, I had 4 different screens on my desk to monitor all the different things that I needed to look at in order to make an options trade. And I realized that a lot of the steps that I took to decide which options to trade, I was taking the same steps over and over again every single day. So it was very repetitive. And that's really why we wanted to start Options Play, because we wanted to make options a lot more accessible for people. And we wanted to automate a lot of those steps, the decision-making process and deciding which options to trade. And that's how we decided, and that's how we came up with the product Options Play. It's a very powerful product in conjunction with what Marc is going to show you guys today with Chaikin Analytics. And the combination of the platform between Chaikin and Options Play is a tool that I use myself every single day in my trading. So I'm really excited to show you guys how you can use the two in conjunction with each other to quickly identify trading setups and leverage that into option strategies, whether you're bullish or bearish on an underlying stock, or if you already own a stock and you want to look for some income generating opportunities, Options Play will help you instantly find those opportunities. So that's what we'll be able to show you here today.
And I think the key to what Tony just said, in addition to his vast experience, is quickly and easily, because we just don't have enough time. And if we resonate with you in this webinar, you're going to realize that picking the underlying stock takes time unless you have the right tools, and then finding the right option strategy takes time. And the combination of Chaikin Analytics and the embedded options play idea generating app really solves the whole issue of how much time do we really have to do this. So I'll start out by just running through the 5 reasons why we should trade options. You can make a large gain with a small investment. That usually means buying a put or a call. You can set up trades with limited risk and unlimited potential. We'll show you what that looks like. There's a lot of flexibility and versatility with options. As Tony said, income strategies, ways to hedge your portfolio. So you can profit on both the upside and the downside by using either puts or calls, and you can protect your portfolios. We'll see in a couple of minutes. Before we get started with the option strategy part, I'd like to do a little poll and start out by asking you whether you're thinking about a bear market. Have you been spooked by the commentators on CNBC? Joe's just put up this poll. It's pretty self-evident. Just say yes, no, or I'm uncertain. I'm not going to tell you how I'm voting. It'll be clear in a minute.
And we'll just give that about 10 seconds. If you don't mind, again, that poll should be right front and center. Just let us know, yes, you're thinking about it, no, you're not, or perhaps you're a bit uncertain. And looks like mostly everyone has responded. So let's go ahead and take a look at the results here. And interesting. Mark?
Well, we've got 36% talking about a bear market. Maybe that's because you know how to use puts. That's pretty high, very high. We've been in the 10% area. So let me tell you what I'm thinking about the market. We've got less than half saying no, I'm not. So Joe, if you close that, let's take a look at the 1-year chart of the SPY, which is the most actively traded instrument in the US markets. It made a new all-time high today. This is the S&P 500 large cap index traded as an ETF. We're looking at a 1-year chart. And as you can see, it was at the top of the page, upper right, going into today. We've had a series of higher highs and higher lows. That's a very bullish pattern. It's a very simple way to define an uptrend. And we continued that uptrend today. And part of the reason that I've been bullish in my weekly market letters, Chaikin Market Insights, is because Chaikin Money Flow, which many of you know through your online brokerage platforms or stockcharts.com, measures institutional buying and selling. And for the last 10 months, institutions have been buying the SPY. How do we know that? Big mounds of green. That means that they're buying the dips, very few patches of red. So this is a way that an institution can get instant exposure to the large cap segment of the equity markets. And so we've been bullish on the market with a target of 2,600 to 2,650 by year end. I think we're likely to hit that target pretty soon and maybe exceed it. But before we talk about that, why don't we go back to March, where we have this big caution circle. The SP 500 was at 2360. It's now at above 2600. That's a 10% gain. But if you were reading the headlines, you might have read this in the New York Times, and CNBC was front and center with stories like this. Caution signals are blinking for the Trump bull market. That was March 31st of 17. We're 10% higher in large caps. Small caps have now joined the party and made new all-time highs today. So I implore you to ignore the headlines, because some very successful market gurus and money managers, from Bill Gross at PIMCO to Jeff Gundlach, who's a big bond manager, to Paul Tudor Jones, a lot of people have been bearish along the way. Valuations, length of the bull market, none of that matters. Earnings move markets. So what's really important, and what we're going to cover in this webinar, is the trend of the market. We've seen that it's up. The trend of corporate earnings, they've been great. Third quarter earnings season just ended last week. On a very high note, 2 weeks ago, Walmart reported fabulous earnings. And more importantly, revenues are up and corporate guidance for the fourth quarter is very positive. So the trend of earnings is up. Once you know those two things, you then want to look for sectors and industry groups that are strong. And finally, stock selection, what I think is the real key to successful options trading. So if you don't believe a word I've just said and you still want to stay bearish, here's a way to hedge your portfolio against a December, January decline. So if you've got a 401k plan with 250,000 in it, you can put on a vertical put spread. Buy the 262 put, which expires on January 19th, and sell the 254 put against it. There's a big green circle there in the options play scoring methodology. Here's a way to make almost 250% on your money or protect your portfolio for a 3% drop in the S&P 500, which I don't think is coming anytime soon. We haven't had a 3% drop since November of 2016, right before the election. Tony, could you talk for a minute about that green circle in the check market and what that really means?
Yeah, so the options play score is designed to help you identify the true risk to reward of a strategy. And the reason we designed this is because when you're looking at risk to reward, a lot of times when you're buying a put or you're buying a call, you have unlimited upside. And that makes it very difficult to calculate what your true risk reward is, let alone risk reward on itself doesn't mean much. You have to weight it by the probability of those risk rewards. And that's really how we came up with the options play score, so that you have a definitive quantifiable way to decide which strategy gives you the best risk reward. So in this particular case, as you can see, when you click on I'm bearish for the for SPY, we immediately identify three ways that you can hedge your long stock position. You can either short the shares, you can buy a put, or you can buy a put vertical. And these three, as you can see on the bottom, will tell you exactly how much profit you would expect or how much you would get from your hedge if you were to purchase this. And this is really telling right now, because you can, buying 100 shares of SPY right now costs $26,000. And to buy protection on it only costs you $223. So less than 1% of the underlying, you can get almost a fully hedged position on. If you're almost a fully hedged position. So if you're concerned about a downside move in SPY, you can currently buy protection for very, very cheap.
And Tony, wouldn't you say that this probability-based way to find the good options trades, it meshes nicely with the power gauge rating, which is probability-based?
Absolutely.
So this is how you protect your portfolio, or if you're truly bearish, as 42% or 50, almost 50% are, then a way to profit on the downside. Again, just a 3% move, and you can make almost 250% in this spread, and your total cost and total risk is that $223. Again, $250,000 portfolio for $2,230. You can ride that all the way to the moon if that's where we're headed, and know that if the market does correct, you've got some downside protection. Now, Tony, why don't you go through these 4 points here, because this is an introduction to options. So I thought we'd start with the options basics and how options play can help.
Yeah, so the options play product itself, or the widget that's available to you through Chaikin Analytics, is designed for all types of traders. And the design is to help anyone to find instant option strategies, regardless of your views, regardless of the underlying. So whether you're bullish or bearish, regardless of whether you're looking at a stock or ETF, we're designed to help you find trading strategies using options instantly. So we have three options when you pull up Options Play. You can click on I'm bullish, I'm bearish, or income strategies, and we'll instantly show you multiple strategies that make sense for that specific view. And this is designed for beginners, so that you don't have to go finding something you don't have to select something before you can see any analytics. And for experienced traders, this is really designed to help you guys save time, so that you don't have to pick an expiration date or a strike price. It instantly does it for you and provides that optimal starting point. And for the novice users who are just starting out and learning, by helping you pick these expirations and strike prices, what we do is we also provide analytics in plain English so that it helps you educate yourself on those strategies so you can better understand what a put is, what a call is, and maybe some of the more advanced strategies if you're trying to get into the multi-leg strategies, which do provide additional benefits if you're trying to take a bullish or bearish view on a specific trade. And all of that is fully optimized for you so that you have that starting point. So regardless of what your views are, you have that starting point immediately once you click on the options play tab.
And we're going to see some examples of that in just a minute. So I'll cover the Chaikin analytics side. We're going to show you how to profit from what we call smarter option strategies. Because if you can find the bulls and the bears with the Chaikin power gauge rating and Chaikin relative strength, are two go-to fundamental and technical indicators, you're way ahead of the game. And then, of course, timing is critical in the options area. We're going to show you how to improve timing with our proprietary buy and sell signals, how to use Chaikin money flow to predict future price movement, not just monitor it. And we saw that with the SPY. And then finally, how to play good defense, which in today's webinar means turning lemons into lemonade by taking bearish stocks and looking for put buying opportunities. So we've covered a lot of ground already just in the first 10 minutes of the webinar. We've talked about the market. We've talked about how to hedge your portfolio. We've talked about the importance of fundamentals and technicals. If you sum all this up, it's the biggest problem we have as traders: information overload. There's too much information and not enough time. So what we've done at Chaikin Analytics is to solve the information overload problem by giving you everything you need to know on one screen. Someone once said it always starts with a chart. You can start Chaikin Analytics with our alerts manager, or you can start with the chart. But if you're on that chart, there's everything you need to know, including options play embedded. You just click on options and up pops that options window that you see here on the right with the strategies similar to what we saw in the SPY. Now, Tony, you might want to talk to why we integrated options play into Chaikin and how important that is.
Yeah, so part of the integration is to really leverage the power of Chaikin Analytics with a tool that can instantly find you ideas to leverage that into option strategies. Because a lot of times when you have a directional view, options can give you that leverage that you need to get explosive returns on an underlying stock. So using the two is really a powerful combination. It's a combination that I use every single day in my trading. I use Chaikin Analytics to help me screen for stocks, and then use options play to decide which option strategies are useful for those underlying stocks. And the different panels that you're seeing in front of your screen, the first panel is the strategies that we've instantly recognized or instantly optimized for you. The second panel gives you an idea as far as what is the expected range or what you can expect that stock to trade in for the foreseeable future. And lastly, the P&L simulator. It's an incredibly important tool to use, because the P&L simulator gives you exactly what your expected results would be if you had bought the stock versus if you bought the call versus if you bought that call spread. And that's a really important thing to compare before you place a trade, because that's usually the most common question that we get is, if you're bullish on a stock, should you buy the stock or should you buy an option? And there's really no way to tell until you actually put the two side by side, give a scenario that you think is going to play out, and see how these strategies will perform. And that's what the P&L simulator allows you to do, so that you can definitively say, yes, I want to buy the stock, or no, I want to buy the call. So that's one of the most important pieces to look at. And then lastly, we have a tab called Plain English. This is really designed for the beginners. Not only is this tool designed to help experienced traders quickly find the trades that they want to make, such as myself, but more importantly, we really want to help educate novice users on options. So when we put the three strategies side by side, you get this Plain English tab that explains each strategy, so you can understand each one and better make a decision as to which strategy is best for you.
And I think that's really important. As we go through the presentation, keep in mind that Chaikin Analytics has really gotten a lot of blessing from some very successful market participants like John Najarian, like Jim Cramer, some of our old institutional clients, Fidelity, Investments, Soros Hedge Fund, Paulson Hedge Fund. And we won the Benzigo Award, as you'll see in the end, for Best Ideas Platform. So lots of validation for what you're going to see. And there are institutional investors and successful traders using Chaikin Analytics in the same way that Tony is. So we'll put Tony up there on the next slide for another presentation. But I'll start out by telling you that there are a lot of option strategies out there. Now, the beginning options trader should probably keep it simple, and that's part of the reason that I love options play, because the simple strategies work. So Tony, you've got a lot of heavy lifting here in the next 4 or 5 slides. I'm going to let you sort of take control, and I'll keep moving the slides along.
Yeah, so the simplest options trades is really buying a put or a call. This is really designed for those of you that are starting out with options. And this is really, if you have a bullish or bearish view on a stock, this is the simplest option strategy that you can use to leverage a bullish or bearish view. The great thing about calls and puts is that they're relatively simple. The premium that you pay on the call or put is the maximum that you will risk, which is really one of the major benefits of trading options, is because no matter what, no matter how much you're wrong, the most you can lose is that premium that you've paid, which for the most part is going to be a very small fraction of buying the same number of shares. So if you, instead of buying 100 shares of a stock, you can buy a call option, it'll cost you a fraction of the price. And if it goes in your favor, you have potentially the same amount of upside as you would if you were buying the stock, but substantially lower risk compared to buying that stock. And vice versa, if you're bearish on a specific stock, you can buy a put, which gives you the opportunity to profit if the stock drops, which is something that a lot of stock traders don't have the opportunity to do, because you may not be able to short the stock because of various reasons. Buying a put is a great alternative to doing so. And here's an example of buying a call on the left and buying a put on the left. As you can see, you get that same upside to the upside, meaning if the stock goes continuously higher, you get dollar for dollar gain on the upside. However, if the stock drops, you don't have dollar for dollar loss. The risk of that call that you pay is limited to what you've paid. So in this particular example, is $100. On the put side, same thing. If the stock goes down, you get dollar for dollar profit if the stock was to drop. However, if the stock was to continue going higher, you actually have limited risk in this particular case. So that's really why a lot of beginners who are starting out with options really like these two strategies, because it's really simple and it helps you define your risk, which is really important when trading, is knowing how much that you're actually risking.
So here's another way to look at it, Tony. You probably got a good way to summarize this. I think it's a different way to look at the chart that we just saw.
Yeah, so the only difference between buying an option and buying the stock itself is that there is a cost of the option plus the cost of commissions and transaction costs that you must overcome before the call option becomes profitable. And that is really the main difference between buying a call and buying the underlying stock, because once you buy stock, the second the stock moves up even by a penny, you're profitable. When you're buying a call option, there is the cost of the option that you have to overcome before you are profitable. So that's the main difference between trading a call and buying a stock. And that's a really important concept to understand, because that is the main difference between trading an option versus trading the underlying stock.
Now, I think that this is the most important slide in the whole deck. You may think that's an exaggeration, Tony, but why don't you explain what we're looking at here and why it is important?
Yeah, so as the amount of money that you pay for a call option will decay as you get closer and closer to expiration. And I agree with you 100% that this is probably the most important concept that to understand before you trade options, because it's vastly different than anything that you're used to when you're trading a stock, because call options expire, or all options expire. So it's important to understand how time affects the value of your option, because if an option that's out of the money, it will actually decay all the way to zero if the call option or the put option is out of the money. So it's really important to understand how time value affects your call option because, or put option, because as it goes by, it actually decreases the value of your option.
And those 95% of options traders at Tucker Anthony who lost money primarily were involved in strategies that bought short-dated options, meaning very little time left to expiration. It's even worse now because you've got weekly options, so you've got to be right almost immediately. And they bought them out of the money, as Tony said. So you do that over and over and over again, and that's a prescription for disaster because of the time decay of options premium. Now, even though the simplest strategy is to buy a put or a call, when you use options play the way I do and the way Tony does, you'll find out that vertical call spreads if you're bullish or vertical put spreads if you're bearish are actually a much better risk-reward ratio. And I don't know that there's much more to say about this, Tony, but if you have something to add, we're going to see examples where, and we've already seen with the SPY, where the vertical spread gives you a much better risk-reward ratio. But I actually remember that you do have a reason for that based on those reduced costs.
Yeah, so the vertical spread is probably my favorite strategy and a strategy that a lot of professionals use when they're trying to make directional bets. And the reason is because of what the previous slide that we just talked about with time decay. When you're just long options, time decay is always working against you, and that's not always the position that you want to be. So that's why a vertical spread is where you're long an option, but at the same time, you're also short a different option. And what that does is it helps offset that time decay, because the option that you're long, you're losing money on time value, but the option that you're short on, you're actually gaining on that time value. So it helps mitigate a portion of the time decay, but also because when you're long an option, you're paying, and when you're short an option, you're getting paid. It actually decreases the initial outlay that you have to get into the trade. So it decreases your the cost of getting into the trade, and also decreases the time decay. Those are two very important things to understand. But that's really why it's one of my favorite strategies to use.
And I remember from a previous webinar, Tony, you saying that if you're trading options actively, that small savings add up. And that's basically what we're talking about. If you can reduce the cost of an option by 50 cents or 75 cents and maintain most of the upside, you do that over and over and over again, your total rate of return, your profit on your account's just going to skyrocket, particularly if you pick the right stocks.
Exactly. So we'll typically we'll usually sell the option that's about 1 standard deviation out. So that will usually bring in anywhere from 10 to 30% of the underlying long option. And by reducing that long option by 10 to 30%, it significantly increases our returns when we are correct, and it reduces our risk when we're wrong.
So let's look at an example of that. This is going to be a vertical put spread because in April of this year, in my Market Insights market letter, I was bearish on the auto parts retailers, Advanced Auto Parts, AutoZone, and O'Reilly. You'd had a negative earnings surprise. When we get into the factors that are in the power gauge, you're going to see how important that is. But you can see on the chart that when the stock reported disappointing earnings, it gapped down from 150 to 130 and then just kept going lower. For a webinar that I did with Tony on August 31st of this year, Advanced Auto Parts, AAP, had rallied from about 80 all the way up to 98 and given us one of our 6 pairs of buy and sell signals. So in that webinar, I used options play to come up with a vertical put strategy. And here's what we came up with. And Tony, you might just want to quickly walk people through this. Just the put versus the spread is probably a good educational tool here.
Yeah, absolutely. And I think it's really important to point out, we did not pick these strikes. We simply put in Advanced Auto Parts, selected I'm bearish, and these were the strategies that options play spit out. We didn't have to go out and find these puts. We didn't have to select strike prices. And I think that's a really important key thing to point out, because if you're if you found Advanced Auto Parts through Chaikin Analytics and you've never traded an option before, simply by clicking on on I'm bearish, you're presented with these three strategies. You can either short the stock, you can buy this October 100 put for $580, or you can buy this 85-100 put vertical for $475. And this is basically saying that if you had shorted the stock, you'd need approximately $10,000 in margin to do so. To buy the put, you need $580 versus $475. So you've reduced the cost of buying a put from $580 down to $475, which from a percentage standpoint is a significant amount to reduce it, because it's almost a 15 to 20% cost savings, which, as you can see on the bottom, if the stock does go down by the roughly 12% or 11% that we were looking for, the difference between paying $580 versus $475 is the difference between 133% return versus 185% return. So that small reduction in cost by selling that 85 put against the $100 put that we bought gets us an additional 50% return on the underlying trade if we were correct.
So let's see how that trade worked out. And this actually is from a live webinar that I did with Tony on the 31st. I like to use examples from previous webinars, good and bad, although most of them have worked out pretty well. So Advanced Auto Parts, from that sell signal up at 98, dropped by the October expiration to 85, and that full profit of $882 was realized. So this is how vertical put spreads can help you reduce cost and benefit, in this case, from a bearish move in the underlying stock. Now, the other strategy that we want to talk about for new options traders, introduction to options, is of course the topic of the webinar, are covered calls. So here again, Tony, I'll let you start out, and then we've got a great example here from, again, a previous options play webinar.
Yeah, the covered call is my favorite strategy for those of you that are just starting out with options and trying to better understand this, because selling options is what professionals use to make money, and this is something that you can use to add to your current portfolio without adding any additional risk. Because what you can do is you can sell call options against stock that you currently own in your account, and by doing so, is instead of paying that premium, you get paid that premium, and you collect that premium as long as the stock stays below that strike price that you sell. And if the stock goes above that strike price, you essentially sell your stock at that strike price, which usually gives you a nice payoff anyway if the stock does rally to that strike price within that short period of time between now and expiration. But if it doesn't, you keep that premium and you can do it again month after month. And the goal of using these types of strategies is to enhance a return or add yield to your portfolio. And options play will actually help you find the ideal starting point for these types of strategies, so that it allows you to potentially generate some income month after month in the stocks that you currently own. And in many cases, we're able to double and even potentially triple the dividend yield on the stocks that you own by selling covered calls against those stocks.
So in Chaikin Analytics, we've got a very visual and powerful technique using overbought, oversold indicators and volatility bands. And Textron, we're looking at a one-year chart of Textron. The power gauge rating is at the bottom. We're going to get into the power gauge, but we really wanted to share some option strategies with you first. Everything was bullish for Textron back in the latter part of 2016. It had broken out at around 46.5. And on a webinar that I did with Tony, I said if you bought Textron based on the Chaikin Analytics breakout buy signal, it's now rallied up from 46, and it might be time to use this stock, which pays almost no dividend, as a covered call writing opportunity. So there were 4 opportunities to sell a covered call out of the money, above the market, on a stock that you already had a profit on. So if you bought Textron at 46, in January, it was trading at 47. We recommended selling on the webinar a 50 strike price covered call. That expired worthless. Then in April, for another webinar we did with Tony, the stock was 47.43. We suggested selling the 49 calls, in this case, 2 of them, taking in $112 for each 100 shares of stock. That expired worthless, as we'll see. Rinse and repeat in July. take in $328. And then finally, here on the right, in September, selling a 50 covered call that expired on October 20th, taking in another $316. In total, on the 200 shares of Textron, you would have taken in about $1,000, little more. So $500 per stock, per 100 shares. And here's what happened. Well, let's see, I think I put that in on the wrong way. Textron, actually, here's the chart of it, traded above 50, so that stock would have been called away from you. So what happens? You bought it at 46, you took in $500 worth of premium per 100 shares, and you sold the stock at 50. So a total of 9 points, roughly a 20% return. And all along the way, you were taking in income on a stock that paid no dividend. So the stock, which moved from 46 to 52 at the end of this chart, where it is right now, 53, benefited from this option writing strategy. Very powerful way to do that. Now, Tony and I were talking about other stocks right now where you might be able to generate an aggressive option strategy, and he, like DR Horton, which we've recommended since September in our weekly market letter at a price of about $36.90. Tony, what did you see? I don't have a slide up, but what did you see in DR Horton that you thought made it interesting for an aggressive options writer?
Well, this was really for those of you who had already owned the stock. The stock has a huge run this year, but a lot of people don't want to sell their stock immediately because they're, especially in this market, people are concerned about missing out on potential further gains. So selling covered calls is a great way to potentially still be in that stock, but be able to potentially sell your stock at a higher price if the stock does really rally. And DR Horton is just, as you can see, it's been trading above its upper volatility band, which is certainly, a sign that potentially there could be a pullback coming up. So it was just all of these things combined that made me look at some aggressive strategies. And when I looked at some of those aggressive strategies, they were paying upwards of 15, 20% annualized return on a stock that currently doesn't pay nearly as much on their dividend. So you can potentially add an additional 15, 20% yield on a stock that's already ran at 82% on the year. And if the stock really does get called away, it's really not a huge deal because you've made a substantial, capital appreciation on the underlying stock.
And Tony, I assume that you're looking at January calls because that would put the tax consequences into 2018. You wouldn't have to pay the taxes till April of 2019.
Yep, absolutely.
So this is particularly interesting because we did have a buy recommendation on this at $36.90, and so people who are staying in there and except for getting nervous and taking your profit prematurely, this is a stock where you could have stayed in it all along. As Tony points out, it's been above its upper volatility band for 2 months, highly unusual. And even in a period of low options premiums, I think the options premium is actually expanding because it's had such a vertical move.
Yeah, so the option premiums on this particular stock is actually still really high. That's why we're getting that 15, 20% yield on some of these aggressive strategies. And that's really what's made it attractive if you already currently own the stock. But you don't want to just get out of it prematurely. You still want to hang on to it, but you want to generate some income or some additional yield, which will also provide some downside protection if the stock was to pull back a little.
So we've covered 3 strategies: buying a put or a call, very simple. You need to know the direction of the stock to make money. We prefer vertical put or call spreads because, as we've shown you, they reduce the cost of an option. And then option writing, either buying a stock and then writing a call that's slightly out of the money, or writing call options on stocks that you have a nice profit in. Real simple strategies for beginning options traders, also used by some of the smartest people on Wall Street. But the key is, where is the stock going? And for that, you need to know about the fundamentals in addition to the technicals. So our go-to indicator, Chaikin Power Gauge Rating. Very simple display, but a lot of number crunching going on under the surface. And as we'll see at the end of the webinar, this can be your GPS during earnings season. It can help you make a lot of money very quickly during earnings season. So this pyramid summarizes and distills this all down into a disciplined methodology, because successful trading demands a disciplined methodology. That's why Chaikin Analytics and options play are so compatible. Power gauge at the top plus industry group strength. D.R. Horton's in the home building industry. Home building statistics have just been through the roof here for the last 3 weeks. The stocks like Beazer and D.R. Horton have been leading the market. So industry group strength, very important. The auto parts stocks were all weak in April. At the bottom, Chaikin money flow and Chaikin relative strength are go-to technical indicators, and then that sweet spot, those buy and sell signals. So here's a sort of advanced look of what a classic Chaikin bull looks like. This is Cigna Corp. At the bottom is the Chaikin power gauge rating as a ribbon that normally goes from red to yellow to green, from very bearish to very bullish. In this case, this has been an easy stock to own and identify. It's been blessed with a bullish power gauge rating for over a year. Started outperforming the market here in January, late December, when the stock was 140 on its way to 205. There's been buy signals along the way, positive earnings surprises. It's up 50% year to date. This is your classic Chaikin bull, and we're going to show you why the power gauge is so good at finding these. So the power gauge is a multi-factor model that looks at factors in value, growth, technical, and sentiment categories. Within each of those categories, 5 sub-factors, so a total of 20, based on everything I learned from working with institutional investors of different styles and time horizons. So this is what's called an eclectic multi-factor model. It doesn't just look for value or growth. It finds opportunity wherever it exists. Value metrics, 35% of the model. Free cash flow to market cap and price to sales ratio are the 2 most heavily weighted factors in the model. And we love earnings surprises, because during earnings season, you can make an awful lot of money if you're on the right side of them. We had one just today on a company called Thor Industries, THO. Company makes recreational vehicles, bullish power gauge rating, better than expected earnings, up over 12% today. And we love industry group relative strength. Now, one of the things you should realize is that when a company reports better than expected earnings, it starts what I call a virtuous cycle. This is what I learned from an associate at Drexel Burnham, George Douglas, who did the original research on earnings surprise and earnings estimate revisions. Earnings surprises come in bunches. There's never just one of them. So quarter after quarter, positive or negative surprises keep building up, and analysts then adjust their estimates, and analyst earnings estimate revisions are the single biggest short-term driver of stock price movement. So here you have a model that was locked down in September of 2010. It hasn't changed in 7.5 years. Factors are the same, the weights are the same, and in fact, on the left, I can't get myself to take this power gauge display out, because in March, on a webinar I did on March 27th, power gauge rating on Lam Research, when it was 127 and change, was very bullish. It's still very bullish, and the stock is trading above, well above 200. I think it's above 210. So these ratings persist because some of the factors like earnings surprise and estimate revisions continue quarter after quarter, and industry group strength. Semiconductors have been leading the market for over 15 months. Lam Research is a semiconductor equipment manufacturer. So let's look at a little bit of performance. In 2016, using the Russell 3000, a very big, broad universe of stocks, very bullish stocks in the Chaikin power gauge rating, like Lam Research, up 32%. Very bearish stocks up only 9.5%. If you're trading from the long side or putting stocks into your 401k plan, you want to go with the stocks with the very bullish ratings and avoid the stocks with the very bearish ratings. The numbers don't lie. And in 2015, if you were bottom fishing or going against the fundamentals, you were in trouble, because the very bearish stocks in the Russell 3000 were down over 18%. These were the energy stocks. Small cap stocks in general were in a bear market in 15. It was extremely important to both trade well and protect your capital to avoid the very bearish stocks. Now, we talked about a pattern called classic Chaikin bulls. Very simple. Power gauge rating is bullish, so that means the fundamentals are strong. Stocks outperforming the market. And Chaikin money flow is strong, indicating that the institutions are buying the stock, accumulating it. So here's another semiconductor equipment manufacturer, Applied Materials, AMAT. The bottom is the power gauge rating, a ribbon for the last year. On top of that, our proprietary relative strength indicator. We've made it into a heat map. It's not a number like you can find in Investors Business Daily from 1 to 99. We look back over 6 months, but then we make it easy to interpret. Numbers contribute to information overload. So when the power gauge rating and relative strength are both green, we say the market agrees with the model. And that's your directional edge. When the power gauge is bullish, stock is likely to outperform the market. When the market agrees and stock starts outperforming the market, you have the ideal combination. And if institutions are buying the stock as they were all through the beginning part of 2017 and doing it yet again, this is a stock you want to use on the long side. You want to use these signals as an entry point. I'm going to highlight only one of the 6 pairs of signals because they're all available on our website, whether you're a visitor or a subscriber. We tell you how we come by these signals, and they're all filtered by either the power gauge or relative strength. So my favorite signal for options traders, relative strength signal. Why? Because when it triggers, it tends to last for 4 to 8 weeks with a 70% accuracy. So how does it trigger? Stock is outperforming the market, dips under its 21-day average, and then goes back above it. When it goes back above the 21-day average, that's when you get your relative strength buy signal. If the power gauge is bullish, it's even more impressive, and the results are fabulous. Imagine if you had bought call options or put on a vertical call spread and been able to benefit from that 4 to 8 week move, and you've got 4 of them on this chart. Very, very powerful indicator for options traders, also for swing traders in stocks. Now, it's good to know that there's a pattern that works, but how do you find them? Again, time is our precious commodity. So for a webinar I did on 24th of May, I used a screening capability within Chaikin, starting with the Russell 3000, looking for only very bullish stocks where money flow and relative strength are 2 go-to indicators that make up the classic bull, were persistently strong. And then I added just one other one, earnings surprise. I love stocks with a history of positive earnings surprises. You've seen why. You'll see more examples of that. So 13 stocks only passed through that screen. Now, as of 2 days ago, I didn't have time to recompute this for today's webinar. It's even better now. S&P up almost 7%. The classic bulls were up an average of 17%. That's probably closer to 20% today, with the S&P up about 7.2. So almost triple the return. And one of those 13 stocks was Cigna at 162, and we see that that's moved up to 205. So in 6 months, a nice conservative, high dividend paying healthcare insurance company, Cigna, has gone up 23% plus the dividends, and we found that stock with the screener. A lot of the other stocks on here like Anthem Health and NVR have had big moves as well. Now, the reverse pattern is equally as important, because if you can avoid the bears like you needed to do in 2015, you're ahead of the game. So classic Chaikin bear, power gauge rating is bearish, telling you the fundamentals are not good for that company. It's underperforming the market, and Chaikin money flow is red, not green, telling you that the institutions are selling the stock. So we're looking at a 1-year chart of Under Armour. Hedge funds loved it. The brokerage firms loved it. It was a darling of the market. Power gauge rating turned bearish at 40, off the charts, about 15 months ago. And it stayed bearish all through 2017. The stock's been underperforming the market. You've had a series of negative earnings surprises. It looked like it was bottoming out here at 18, and then you got a negative earnings surprise, and it looked like it was bottoming out at 16, and you got another negative earnings surprise, and the stock dropped all the way to 11 and change. bottom fishing, listening to those people on CNBC telling you, well, this might be the time to step into Under Armour. How many of you have been swayed by that? Before I built this model, I would pay attention to these people. Now, what we recommend is filter their recommendations through the power gauge. It's objective, independent, quantitatively based fundamental research, and then look at the technicals. It's so easy. And you would not be bottom fishing in Under Armour. Now, we talked about how important industry groups are. So in our weekly market insights, we identify 3 strong and 3 weak industry groups and then 3 stocks within those groups. So just about a month ago on October 22nd, consumer products, miscellaneous staples was one of the 3 weak industry groups that we highlighted. And there was a stock called Newell Brands. They made a lot of acquisitions. They own Goody Products, which makes those inexpensive hair clips that you buy at CVS or Rite Aid. Showed up as a weak stock in a weak industry group with a bearish rating. And about a week later, they reported a negative earnings surprise. And here's what happened on that morning. The stock gapped down 26%. So 2 things where you could have benefited yourself. If you own Newell, could have gotten it out of your portfolio ahead of that negative earnings surprise, or when you got this overbought sell signal, when the stock made a new 8-day high with a bearish power gauge, could have bought a put option or done a vertical put spread because it wasn't immediate. It took 3 weeks. The stock did drop from 43 down to 40, but then you got that big earnings surprise, and that was your big payoff. The put option would have given you a much bigger payoff than the vertical put spread, but time decay would have been working against you. So all the variables come to play, and you just go up to that options button, click on it, and you find the strategy that's best for you. Now, there's a pattern that we call spotting personality changes that I think is the key to making and keeping profits. We define a personality change as a stock that's been outperforming the market that begins to underperform the market, or a stock that's been underperforming that begins to outperform. So DR Horton is an example of a stock that went through a personality change in late February of this year. It had been underperforming the market with a bullish power gauge, and then it started outperforming the market. Notice that that's when you got your price acceleration beginning. Stock was around 31, 32. So it was important to know that that personality change had taken place. And we make it very easy to find these with our list manager, or if you're following the stock or the industry group, you'll see that on the chart. And of course, all those wonderful oversold buy signals were great options entry points. These are good for 5 to 10 days, relative strength, 4 to 8 weeks. Now, on the downside, it's even more important. So Tesla, which is everybody's favorite cult stock, Elon Musk, I've called him the P.T. Barnum of the 21st century, great at promoting his companies, but very poor at delivering automobiles on time. So if you like the car, buy the car, but sell the stock. That's been my advice for 3 years now. Power gauge is bearish. You've had a bearish personality change, so the stock has started underperforming the market. It's below its long-term resistance line. This is a great put candidate on strength when you get those overbought extremes, a little bit of short covering from 290 up to 320, perfect spot to put on a vertical put spread. Now, in SunEdison, going back all the way to 2015 and 16, it was really important to spot that personality change. Why? Because the stock, which had been trading at 30 and was the darling of Wall Street, Merrill Lynch had a buy recommendation on it up there. Hedge funds loved it, but they were doing Enron type accounting. Saw a bearish personality change when the power gauge was bearish and institutions were selling the stock. And we know that because Chaikin money flow is deeply in the red and stays there. Persistency of money flow predicts future price movement. So those sell signals were great opportunity to put on put spreads. Could have gotten out of the stock up here at 26. Now this chart ends in April of 2016. The reason is up here on this screen capture from CNBC. Company filed for bankruptcy. in April of 2016. Merrill Lynch did put out a sell recommendation on this in February at $3, down from 30. And this is not a knock on Merrill Lynch. Every firm on Wall Street has been in this position. The reason is analysts put their feet in cement. They fail to spot the personality changes. They fail to spot the fundamentals changing. So you need an independent view so that you can be smarter than Wall Street analysts. Now, we got this testimonial from a Merrill Lynch financial advisor who saw a demo of our product at an options conference in California about a year and a half ago. He said, I bought SunEdison, which my firm Merrill Lynch was still recommending, at 15 on the way down. If I'd been using Chaikin Analytics, I would have saved myself and my clients a lot of money and pain. And that's the whole purpose of this. It's not just to find great put trades, it's to protect your capital and benefit turning lemons into lemonade. When you find a stock like Under Armour or SunEdison, there are going to be multiple opportunities to buy put options or vertical put spreads. Now, everything we've been talking about is what we call the ideal setup. Power gauge bullish, industry group strong, outperforming the market, Chaikin money flow bullish. Warren Buffett calls that the fat pitch because he has said they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. You can wait for your pitch. He calls it the fat pitch. We call it the ideal setup. And the missing ingredient, the buy and sell signals that we've been looking at, 6 pairs of them. And again, nice to know that they're around. How do you find them? We have dashboards. So this is my dashboard alert from our iPad app. For a webinar I did on August 10th, I got a series of buy signals on stocks like Boeing that have had big moves, Michael Kors, as we'll see in a minute, and a sell signal on Bed Bath & Beyond at 29.78. Relative strength sell signal. Remember I told you 4 to 8 week time duration. That red arrow is where the sell signal came, and it came nestled right in between 2 bearish earnings surprises that were preceded by relative strength sell signals. So 3, 4, 5 opportunities to put on a bearish position in Bed Bath & Beyond, and each one of them was successful. And you see that 4 to 8 week time horizon play out. And the stock, this chart is about a week old. The stock's trading at about 21, looking like it might be finding a bottom, but nobody knows. So don't bottom fish, please. Follow the signals. They're disciplined. It's better than trading on your emotions. Now, I'd like to end the webinar with something I call winning plays during earnings season on both the long and the short side. Best Buy, actually we featured this in a webinar back in May, had triggered an oversold buy signal. That was a new 8-day low in a stock with a bullish power gauge rating. In May, they were due to report earnings 3 or 4 days later. They had a series of positive earnings surprises. They reported much better than expected earnings. The stock gapped up over 20%. So if you bought options on that buy signal ahead of the earnings report, you did pretty well. And then it pulled back again. Why did it pull back? Because Amazon said they were going to get into the Geek Squad business. Stock pulled back, profit taking, gave you another buy signal and another short-term trade. But we got this testimonial from a new Chaikin subscriber who said 257% profit in 24 hours on earnings. Gave options one more try. Here's someone who was not being successful with options. He was part of that 95% who lose money. I was surprised with the results. A Best Buy options trade was my biggest winner of the year. I don't think I would have ever attempted an earnings trade without the guidance in your webinars. Now, going back in time to 2015, here's what Yelp, an internet sort of directory of hotels and restaurants, looked like. It looked a lot like Under Armour, trending down. We made it our bearish stock of the week. The dynamic duo was weak. That's our combination of relative strength and Chaikin power gauge rating, underperforming the market. So right where that red arrow was, ahead of the earnings, we made this our bearish stock of the week and got this testimonial from Mike. And this is before we had options trade options play integrated into Chaikin. So Mike found these on his own and gave us the ledger. I think this is from his Interactive Broker account. Netted $17,408 in profit this morning. I found more success in the past 2 weeks using Chaikin than I've had the rest of the year. Had the biggest winner of the year today on Yelp based on Marc's bearish play of the week. Risked 7,000, netted 17,000. And he actually showed us the trades. And he's probably a little more sophisticated than most options traders. He found 3 different trades. You could have found very profitable trade using options play. Now here's a stock that looked pretty much like Yelp. Tesoro, which is a drug company, TSRO, bearish power gauge rating, underperforming the market. And right in here, we got one of our overbought sell signals. Stock looked like it was bottoming out at 110, and then they reported a negative earnings surprise. And just as with Yelp, if you had put on those put positions ahead of that, stock dropped from 110 to 80. We've been using this stock in our webinars for the last 3 months. And investors, traders who saw the opportunity to buy put options benefited handsomely, just like Mike did on that Yelp trade. Now, everything we've been looking at is all part of Chaikin Analytics for both iPad and desktop. And I mentioned earlier that we won the Benziga FinTech Idea Award for Best Ideas Platform in May versus 19 other entrants in that category. So very proud for all the 26 people here in Philadelphia at Chaikin Analytics who work so hard, development, customer success, and so forth, to get us to the point where we could have such a powerful idea generating platform. Now, Chaikin Analytics, at its heart, the centerpiece is the 20-factor model. That's really what is special, enables you to combine fundamentals with technicals, so your options trading benefits from that directional edge. Also includes the stock discovery engine, which we haven't talked about in this webinar. It's a way to generate ideas similar to how Spotify finds you music or Netflix finds you movies. And I guess Amazon finds us everything else in life. And that's what we won the Benziga FinTech Award. Put in a small cap semiconductor stock and get back a stock like Acellus, which went from 2173 to 36 after the stock discovery engine produced this display. So very powerful idea generating tools within Chaikin, plus bonuses. You've seen the screener and options play. There's a lot to Chaikin Analytics. And it normally sells for $2,195 for an annual subscription. But as a webinar special, we'd like to offer you $300 discount, reducing the price to $1,895. Go to chaikinanalytics.com/options. This special offer expires midnight Friday, December 1st. And prepare yourself for this final month of the year, which we think is going to be a rip-roaring upside move for the stock market. Find those winning stocks, get out of the losers, adjust your portfolio, adjust your trading, take advantage of this special offer. Now, I mentioned that Jim Cramer was a fan of Chaikin. He had a live paid teach-in event in New York. I was the featured speaker, very proud because there were people like John Najarian and JJ Kinahan from TD Ameritrade on the panels. But while I was showing the audience, 300 people in New York, very similar presentation to what you've just seen, Jim Cramer live tweeted, Chaikin Analytics model is the best used at my old hedge fund. So great shout out from a very, very fine stock picker. There are additional bonuses in Chaikin Analytics. Intraday charts, so you don't have to go back to your online brokerage platform every 5 minutes to see what the stock has been doing all day. Earnings alerts, and our weekly newsletter, Chaikin Market Insights. So we got this testimonial from Ken H., and this is about as extreme as it gets, from $235,000 to $1.2 million in 7 months. He started using Chaikin at the beginning of 17, had not been doing well trading options, and grew his account over 5-fold using the methodology that you've been looking at today. But one of the other things that Ken did is he took advantage of our one-on-one coaching. As a Chaikin subscriber, you get Small group tutorials 3 times a week, unlimited coaching, one-on-one support if you need it. Ken took advantage of that 2 or 3 times with our options specialist, Josh Minlin, and my colleague, John Schlitz's Daily Morning Insights. So when you subscribe to Chaikin, you become part of a family, and we help you understand what's in the system, Chaikin Analytics, and how to use it to trade profitably. So I'd like to offer you a fast action bonus. We've got all of our customer support and salespeople here, so let's show them some love. Fast action bonus. If you subscribe by midnight tonight, we'll take an additional $100 off the cost of Chaikin Analytics. You save $400, plus for the first 10 people who subscribe tonight, a one-on-one phone session with me. We've done these before. People like them. I like them. It's fun to connect with our clients. So subscribe to Chaikin Analytics by midnight tonight. You get a $400 discount, reducing the cost to only $17.95. John Najarian once said on a webinar, and I thought it was a little radical, folks, if you can't make that back on your first trade, you're probably not suited for options trading. It's not quite that extreme, but you should be able to trade using the options play module, find the ideas. So Chaikin Analytics, subscribe by midnight tonight, get that one-on-one phone call with me, and $400 off. With that, I'd like to thank our partner, Tony Zhang, for another great webinar. He sort of had to wing it because we prepared 2 webinar decks today, and Tony, you did a great job. Thank you very much.
Thanks, Mark, and thanks everyone for joining this afternoon.
So we'll turn it back to Joe Bacella to wind down the webinar. I know he's put in the link to the fulfillment page with the discount. And Joe, it's all yours.
Awesome. Thank you so much, gentlemen. Thank you for your time. And everybody, thank you for joining us for this presentation. Again, to reiterate Marc's offer, I believe you'll see the fulfillment page right now. That is $17.95 for a full year to Chaikin Analytics. Again, great discount for, again, entire year's worth of access. That includes the options play widget within the program in addition to Chaikin Analytics. Just simply go to chaikinanalytics.com/options, or you can give us a call at 877-978-6257. We'll be sticking around late tonight, so more than happy to answer any questions you may have. In the meantime, of course, tomorrow we are hosting our onboard session. This is perfect for everybody in your position. This is where we're going to show you all of the ins and outs of Chaikin Analytics, give you an idea for how our platform works, and make sure that you really kind of hit the ground running. There was a great comment that was chatted in midway through the presentation. Pretty much, long story short, someone who joined our program a few weeks ago came in with a few $1,000s that they were trading and came away after, it looks like if I read this correctly, about 4 weeks, made a already 23% return on their debit trades, which is fantastic. So it's great to see the immediate results. And again, we have a great support program here to make sure that you can be successful as quickly as possible. So by the way, thank you very much for that comment. In the meantime, everybody, hope you enjoyed the presentation. Keep an eye out for the recording tomorrow. In the meantime, again, that's chaikinanalytics.com/options, $17.50 for a full year to Chaikin Analytics. Till then, big thanks to Tony Zhang, big thanks to Marc Chaikin. In the meantime, have a wonderful evening, and we'll see you on tomorrow's onboard session.